Hello and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Valdana Hayek, a cross-asset reporter with Bloomberg.
And this week on the show, well, despite all those doom and gloom predictions about a recession on the horizon, the job market remains red hot, with the unemployment rate at just 3.5%. Yet, with inflation at a 4-decade high, many economists believe that some pain in the labor market is needed to get consumer prices under control. But is that necessarily true? We'll get into it with a veteran economist. But Valdana, I have to ask you first, how many cups of coffee do you drink a day?
Do you want to guess?
I want to guess. I want to say 0 cups.
Yeah.
0 cups?
Yeah.
Really? No cups?
How did you know?
Because I felt like it was a trick question. Even though I asked it.
Yeah.
Why no?
How could you know it was 0? I'm so hyper usually.
I know, but it's something
you
you're
wouldn't
also
guess
very
0.
healthy with the cauliflower.
Oh, the cauliflower.
Diet.
I love cauliflower. If there were cauliflower coffee, I would have that.
Yeah.
Yeah. No, I stopped drinking it earlier this year, actually.
Yeah? No caffeine at all?
No caffeine.
Really?
Yeah, it was giving me a headache every time I didn't have it, so. I don't think it's for health reasons. I mean, I think it's healthy for you, right?
Well, I don't know. The headache is, I've never gotten past the headache. I need it every day. How do you get out of bed in the morning then?
Well, I had food poisoning, so I couldn't eat anything at all. And so that's when I stopped just drinking it. I don't know.
Now I feel guilty about all the coffee I drink.
How much coffee do you drink?
Well, it depends. Are you buying? If you're buying...
I'm buying, yes.
Then 5 cups.
But we're not going to Starbucks because that's $7. We'll go to the little stands.
All right.
The little carts.
Good.
But our guest, actually, I think she drinks a lot of coffee.
I have a feeling she does.
Yeah, I have a feeling. Our guest today is Nela Richardson. She's a chief economist at ADP. Nela, thanks so much for joining us.
Oh, it's great to be here with you. Thanks for having me.
Well, I think the reason we're talking about this is because you had a blog post recently where it was titled "Inflation and Coffee: A Love Story," about how you go through how prices have gone up, but the Fed's not really paying attention to things like food costs. And you said there's a problem with this kind of thinking. So I was hoping we could just start out with you talking about this.
My love of coffee and my dislike of inflation. That's a great way to start. Yeah, I mean, I do love coffee. And I think that actually coffee is a good prop for what's going on in the global economy, not just domestically. So coffee prices, you mentioned that $7 a cup of coffee across the street. Coffee prices are actually up almost 16% from a year ago. And, when everything is going up, isolating one thing seems like you're piling on, but coffee is kind of unique because for all those years and months leading up to the pandemic, prices were either flat or falling. So to see this big surge in year-over-year coffee prices, it's for a lover of coffee, it's traumatic. It has been for me. I won't say how many cups I drink. I'm generally just a morning coffee person, but coffee is important to some of us, but food prices just writ large have been going up. And the point of the blog is, coffee represents a global supply chain that's quite complicated, that has been affected by the pandemic. It represents the big surge in food prices that we've seen over the past year. It represents the fact that Main Street sees food and gas as inflation. But when the Federal Reserve makes monetary policy, they exclude food and gas prices and volatile prices and look at core inflation, what's known as those baskets of goods that are not affected by something that's really, really volatile, like coffee. So while I pay a lot of attention to coffee, the Fed doesn't. I'm sure they drink it.
I guess their argument, Nela, is that, as you say, those prices can be so volatile. If there's a bad harvest in Colombia or if there's a hurricane, the oil prices are going to go up. Are they wrong to do that, though, do you think? I mean, should the headline number carry more weight for the Fed, do you think?
I think the headline number should carry more weight because it feeds consumer expectations. And we know that the long-term driver of inflation is what people think will happen with inflation. So if you think that prices are going up, you are going to behave in a way that actually causes prices to go up, like go to Trader Joe's and hoard a bunch of coffee in your cart because you think that, next month it's going to be higher. Not saying I do that, but it could happen.
That example was a little too real there, Nela.
Too close to home. Yeah. Well, experience is our best teacher. So with the Fed, while the Fed is not looking at coffee or food or gas specifically when it's really focused on its interest rate policy, it is well aware, as we all are, that consumers see it, and that's what consumers are judging. And if that feeds back to long-term inflation expectations, then we have a problem that spirals beyond, the window that the Fed is executing its policy in.
Well, I know, Nela, you pay a lot of attention to consumers, so maybe you can talk a little bit more about consumer sentiment right now, because I wanted to ask you if it's not the case that the wealth effect is also very real right now, where we're seeing, obviously, a downturn in the stock market and also a slowdown in the housing market. And does that not also affect the way consumers are thinking about things?
I think it does. I think that's an important attribute of consumer spending. That's the bulk of the economy. And so when consumers, especially wealthy consumers, feel confident about the economy, they spend more. But at the lower end of the income spectrum, it's not about confidence, right? You're spending on necessity. So you spend when you have it at the lower income. And so we've seen a transition of who's driving the spending in the economy from those people who benefited from those direct payments from the federal government through the heart of the pandemic. That translated into a lot of spending, which helped the U.S. avoid a prolonged downturn and led to a pretty speedy recovery. Now, on the other side of inflation, when things are slowing down in the stock markets and in the housing markets because of higher interest rates, you might start to see a slowdown in the spending of upper income folks, where the wealth effect is more prominent in their decision making.
Yeah. Well, I know, Nela, now at ADP, you're sort of laser focused on the job market too. So let's get into that a little bit. Wage growth has picked up, but it is still lower than the rate of inflation. So in other words, what they call real wage growth is negative, which means if you get a raise, it doesn't necessarily feel like you're getting a raise because all your consumer goods are rising even faster. And, that obviously triggers a lot of concern about what they call the wage cost spiral, where labor demands higher wages to keep up with inflation. Are you seeing any signs of that? I mean, is that a risk that this inflation might prove to be stickier than everyone's hoping?
Let me take the second part of that question about, is there a risk that inflation is stickier than we think? Yes. Yeah. Now, the second question that preceded to that is the wages going to be the main driver of that stickiness. I do think that wages, because they have accelerated so quickly over the past year, and ADP data, and we have some really good data on this, as paying over 25 million workers in the United States, it's showing that wage growth has been elevated and is now kind of bottoming out at this higher level. So in our latest report for August, we show that wage growth for the median worker who stayed in the same job for the past 12 months was 7.8%. Now, to put that in perspective, in spring of 2021, that median wage growth would have been around 2%. So a huge acceleration, but the 7.8% is basically in line where we've been for the past several months. So we're not seeing it go up dramatically, but it is elevated. And I think that's the story of inflation overall. Perhaps we are slowing down from acceleration, but for many items, from coffee to your paycheck, those prices are elevated, and the growth rate is kind of leveling out, but still growing.
Right. So do you think there's, the only way to cure inflation is in part to weaken the job market a little bit?
No, I don't think that's the best way at all.
Yeah.
I think that's a horrible way to cure inflation by destroying demand. I think that's the worst way. I think a better way, a way that, involves more than just the Fed. That's the Fed's tool, but it's about productivity. Productivity grows you out of inflation. When more workers produce more output for the same amount of cost, that's what productivity is. That's what gets you out of the inflation wage price spiral conundrum. But that takes some other muscles that the economy hasn't really used all that well. It takes business investment. It takes government investment in jobs and workers. It takes more partnerships with community colleges to build an agile and skilled workforce in the places that the economy needs it. So we're relying on a tool that is blunt, yes, but also painful by its own, by the Fed's own words. And there are better tools. We haven't had to use them in this economy until now.
So then can you talk a little bit more about the jobs market? Because we have been having a very strong jobs market where we're getting numbers that are just so much better than a lot of times what economists are expecting overall. How long do you foresee that happening? And do you foresee a potential slowdown in the jobs numbers?
Yeah, the slowdown is inevitable in the jobs numbers. I mean, we've already seen it. You can't expect an economy in normal times or as close to normal as we're going to get from here on out to produce 500,000 or 400,000 jobs a month. That's not the U.S. economy or any economy I'm aware of. Something more normal makes sense. And I think what you're seeing is not necessarily a slowdown, but a normalization of job gains post-pandemic, right? And so we're still seeing some really solid job growth. And what we're hearing from clients at ADP is that they're still trying to find qualified workers. That's the top concern of many of our, especially small business clients who've been outcompeted by larger companies who were really aggressive in hiring over the last year. Those large companies are slowing down, but they're just making room for smaller companies to hire instead. So we think we'll see some pretty steady gains ahead, but slower than what we've seen over the past 6 months.
Right. Well, it's interesting. I keep thinking back to, I forget who invented it, but it's called the misery index, and it's basically just very simple formula. You add the inflation rate to the unemployment rate. And, that's supposed to give us an indication of how miserable we all are. I mean, I guess it depends on how much coffee you had in the day, too, on an individual basis. But
so I'm miserable all the time.
You said it. Let the record say I did not say that, Valdana. But, I think, Nela, the issue is that the unemployment rate can obviously be very low. But if that inflation is high, if real wage growth is negative, it sort of makes a lot of people miserable rather than, say, in a recession where you get 10% unemployment, you've got 10% of the people miserable. You know what I mean? As opposed to in this environment, you seem to have everybody miserable with inflation. So is that the equation, do you think, that the Fed is trying to solve right now, that inflation is almost a bigger sort of destabilizing risk in society and the economy than a recession, and sort of, a recession is the lesser of two evils for the Fed trying to sort of chart its course?
Yeah, I think that's a great question, Mike. I mean, it's always positioned as inflation or recession, but, I'm bearish enough to think that you could have both, especially when I don't have coffee. But for the Fed, I mean, it really is. And in my view, too, for the very reason that you said, inflation is job number one for the economy, because without getting inflation under control, workers don't benefit from a growing economy. All of their paychecks are eaten up by inflation. And so in order to get that productivity that leads to growth, you have to have inflation that's manageable. The economy just can't operate without having stable prices. And so I think the Fed's priority list is in the right order. It has to be about inflation until inflation is under control.
But then, Nela, how realistic or maybe unrealistic is the Fed's 2% target on inflation?
Yeah, those goalposts probably would love to move them. Some of those disinflationary forces that we've relied on for the past 10 years leading up to the pandemic are just not working so well anymore. The whole idea of globalization bringing prices down, of having just-in-time inventory that kept price and costs low, those things are kind of fragmenting at the seams. And the way that we're sourcing things like semiconductors around the world, it changes the landscape for inflation. And so in my view, this episode of inflation is just one of a future world where inflation is more frequent and more persistent. It's not that the Fed is doing a one and done battle with inflation. This is going to be an ongoing war. And so what they do now, I think, sets the tone for the future. So yeah, I actually forgot your original question, but I got in my own tandem. But I said
how unrealistic is 2%, and so maybe just to add to your point, how much longer do you foresee them? If we're going to be continuing to see persistent inflation, for how much longer do you think?
Yeah, I don't have a crystal ball on the length of time, but I think it could be that inflation does stay a bit elevated, or for the purpose of this audience, that interest rates have to stay at higher levels than they are now in order to keep inflation under control for several months or even, in the next year or two. And that's probably not great news for a lot of people. But the 2% target, I don't think the Federal Reserve would change that at this point. You don't change the goalpost in the middle of the game. You have to wait till after. And that's because it's not just about inflation. It's about the Fed's credibility and changing it to something higher. They kind of already did that before the pandemic, but that was to get inflation up. Now they're trying to push it down. And so changing the target to 3 or 4%, as I've seen suggested, really would, their credibility would take a hit in doing that.
Nela, obviously, it used to be, not so much anymore, but it used to always be every month in the market. The biggest main event of the month was the jobs report, and which means that 2 days earlier, you guys come in, ADP comes in and scoops the government with your own jobs report. And that is also highly anticipated by everyone and often market moving. I understand you guys have made some changes to the methodology. Could you tell us a little bit about, about what you did?
Absolutely. And honestly, Mike, the jobs week is still my favorite time of the month. It's the most important to me. I'll let you guys break down the CPI, but I'm always looking forward to jobs week.
You can't take vacation those weeks, I take it.
No, it's a remote world. So I don't have to be in the office, but no, I can't take it. And wouldn't want to, honestly. I'd miss all the fun. But what we realized at ADP is the need for real-time data, especially during the pandemic. And we knew that with the scale we had and the breadth of data that we could offer, paying over 25 million workers, that we could be more than just a 2-day forecast of the BLS numbers. We could actually provide an independent estimate based on ADP client actual pay of what's going on in the labor market. So this is not survey data. This is real pay data, and it's very well crowdsourced. Our whole business model is based around paying people and paying them on time. And so it was an important, I think, advancement in the way that we use data as an estimate. And I think it's not going to be the first. The need for real-time data on the economy from the private sector has grown exponentially. The government institutions realize this. They are incorporating some of this in their own statistical infrastructure. It's just another supplement of what's going on in the economy. There's a lot of people who will talk about the future of work and give you a forecast, but when you look and see what's actually going on in the economy, that really helps drive business decisions because it's based on something real, not a model.
I was going to ask, okay, so every month the government, I think in the establishment survey, they survey something like 100 and some thousand businesses and get the responses. You guys have the actual hard data from 20 some million payrolls. Isn't that a more, I'm kind of a softball for you here, Nela, but it seems to me like you have a more accurate view on the labor market than the government. Should the market be paying more attention to your report than the BLS report, do you think?
The market should pay a lot of attention to the ADP National Employment Report. So I'm on record for saying that. And it is an independent estimate. And I would say that the BLS estimate is also an important and has a long-lived lifespan in terms of providing data. So I am not on the record as saying that this is a replacement for government data. I don't think that. I think that this is a private sector view that is highly complementary to government resources, and it doesn't have to be an either or, it should be an and. So this audience is sophisticated. They're really good with numbers. They can hold two numbers together. And what we've tried to do at ADP is make it as easy as possible. So when we launched the new NER, we did it with 12 years of weekly data, cut by sector, cut by geography, industry, and establishment size. So it's really an opportunity. Dig into the numbers, see where the NER and the BLS match up, see where they differ, see how it performs over the business cycle. And we're really excited to be able to provide that level of detail. And last note on this, we did it in collaboration with the Stanford Digital Economy Lab. Stanford has been a great partner, but we wanted to make the methodology as rigorous and transparent as possible. So partnering was important for us.
Can you talk more about the differences between your number and the BLS number? Because yours comes out 2 days before the BLS number, inevitably somebody tends to point out that there is a discrepancy between the two, that they don't always match up, and sometimes the gap is pretty wide. So maybe you can tell us a little bit more about that.
Absolutely. And you shouldn't expect them to match up because they're totally different samples. The BLS is based on the CES survey run by the Census Department, which essentially asks establishments, how many people did you pay this week? Right? So it's a survey data. And there is some issues around survey response rates that have been made more apparent during the pandemic. We're all feeling a little survey fatigue these days, and establishments are no different. So what the ADP data does is it says not how many employees did you pay this week, establishment, but we count how many employees are actually on your payroll. So it's a slight difference in also perspective, and it's based on actual pay data. So if you look at your paycheck and you get that in direct deposit, that's what we're counting basically for all of our establishments. But the great thing about the number is we have such a breadth and scale that we actually re-weight that number with the quarterly census of employment and wages. I remembered it, QCAW, which is a near consensus of all the establishments in the country. It's about upwards of 90%, full data on all the businesses in the US. And so now we have something that is a private sector view, but it is re-weighted to look at the national average. And I realize that that's a long answer. So any more detail, we have the technical note on our website, adpri.org. And thank you for not cutting me off, because I think I would have cut myself off if I had gone on that long on something. But you guys are so polite.
I'm actually not that polite because I said inevitably somebody points out the discrepancy between the ADP and the BLS.
Yeah.
I'm that person.
Yeah. Don't worry, Nela. Vildana is not polite at all.
I'm not. Sorry, Nela.
Well, Nela, I know, and in sort of past stops at your career, maybe more so, but you definitely keep a pretty close eye on the housing market too. And we've seen, obviously, some softening there, not only in home sales, but actual prices have finally seemed to come off the boil a little bit. I forget the superlative, like the biggest, month over month drop in over a decade or something, the last Case-Shiller index. How do you see housing sort of landing from this red hot housing market that we had? And are there sort of knock-on effects to GDP and inflation that could come as a result?
The tailwind to housing is long. I'll start there. Demographics is destiny in the housing market. And you have a whole bunch of young people, millennials, who still want to buy a house. Yes, they've been stunned a little by the rapid increase in both house prices and mortgage rates, but that demographic tailwind is still singing loud and clear. And so to me, I think the fact that where we are actually seeing weakness in the economy is like the lowest hanging fruit, right? Because you already had a stricken market that has been undersupplied, chronically undersupplied for over a decade. So this supply shortage story in housing, it's not about the pandemic. It's not about recent rises in lumber. This has been going on for 10 years. And it was only because rates were supernaturally low that anybody could afford a house. And now you've taken that away. But it doesn't just affect demand, it affects supply. If you look at home builder sentiment, it has plummeted because not only has the cost of constructing a house gone up, so has their financing costs. So you're depressing the entire housing market with a higher interest rate. It's become smaller, and yet you still have this huge tailwind coming. So I think of this as temporary. Whatever we're seeing in prices, it will readjust again once people get over the sticker shock of a higher mortgage. And we won't fix it unless we build more homes, especially at the affordable sector. So last comment on this, we used to have a housing policy in the US, and, it survived both Democratic and Republican administrations. We don't really have a national policy around home ownership the way we did when I started my career. It's almost like it's a forgotten goal of the American dream, to be a homeowner. Have we given up on it?
What would you like that policy to look like?
I think it starts with affordable housing, whether it's rental or ownership. But because it used to be back in the olden times, like the 1990s, maybe 2000s, home ownership was your path to the middle class. If you bought a home and you had that forced savings and it grew over time, then you created wealth for you and your family. Now you need wealth to buy a house. It's like, let me go create my wealth first, maybe in Bitcoin or the stock market, and then I can afford a house. We've inverted the American dream where you have to get wealthy first before you can become a homeowner. And I think that that's part of the discontent that you're seeing show up in the consumer sentiment numbers. And that's not going to be solved by just getting inflation down. That's kind of something that we're stuck with, and we need to actually be intentional about affordable housing.
I'm really happy you brought this up, because one of the questions I had for you is about where and how we're seeing the unequal effects of the Fed hiking rates. So housing potentially is one area. I don't know if you had something else on mind. I do know you track this very closely.
Credit card costs. I mean, the reason why the country has stayed afloat, it's on the backs of the consumer. It's always the case, but the consumer has been incredible. It's like higher egg prices, okay, I'll buy it. Higher airline fares, okay, I'll buy it. But they're starting to buy it less out of savings and more on credit card balances. And as someone who has studied Canada and looked at what the effect of consumer debt can do to an economy, and this is before the pandemic, our friendly neighbors to the north are a telltale sign of what could happen if consumer debt in the United States starts to rise and then explode to keep up with the current pace of spending. So I think it's really a watch point, especially for those in the lower income strata, because those are the ones who are affected most by inflation, by higher rents and higher food prices and gas prices. So hopefully they'll get some relief on that.
Well, one area where there is some debt relief is the student loan issue with the Biden program to forgive some student loans. How do you see that playing out? Is that going to add some inflationary risks, or is it going to sort of have a more positive effect on the growth side that would outweigh any inflation concern?
It's a great question. I don't know. I'll just say it frankly. I wrote about student debt forgiveness in my Main Street Macro blog last week. And, the question of whether student debt is a mountain or a molehill when it comes to inflation is still to be determined, because who knows if people, there's been a forbearance on student debt repayment for a while now. So forgiving it outright, who knows what effect that will have? Will people buy more refrigerators because they don't have to pay and they haven't been paying a student loan debt? I do not know that. I don't know what the marginal increase on inflation will be. What I do know, though, is that people with college degrees are much better served in a recession than people without. I do know that college enrollment is dropping, and I do know that productivity in the U.S. is also on the decline. So we need a skilled workforce. That I do know. And how to get there is an important question to ask for the future. Whether or not college is out of reach for people these days is another question that I think deserves some policy consideration.
So, Nela, before the pandemic, you and I used to get together all the time at the Bloomberg offices, and we would talk about the stock market.
And drink coffee.
We would drink coffee. Yes, so much coffee from the Bloomberg offices. And we would talk about our love of New Jersey, right? Right. Very fond memories of that. But anyway, you said recently in a note that the market isn't necessarily in lockstep with the economy. And I wanted to ask you about this and what you meant by it.
I think the market is reflecting some of the angst and the uncertainty that's been on Main Street all along now. So I'm going to actually reverse my position on the market. I think the market was acting in certainty, fortified by the fact that they felt like they understood what the Fed would do, that inflation would come down, and there'd soon be a pivot. And I think there's now a recognition that may not happen, or it may take longer to happen than previously desired. Because what's happened, I think, over the course of that month is that we got another CPI reading, and the core inflation bumped up instead of going down. And that was surprising. It was even surprising to me, who wasn't as sanguine about the inflation story as what I saw in the markets. So I actually do think that the markets are reflecting uncertainty. I don't know how long the markets will do that, but that's the same uncertainty that Main Street is feeling right now.
Right. Well, Nela Richardson, chief economist at ADP, it is always a treat to get your take on the world and all things involving the economy. But I have to say, as a veteran of this show, we cannot let you go until we hear about the craziest thing you saw in markets this week. So I'm confident you came prepared. But Valdana, let's start with you.
Okay, you're going to love this one.
All right.
I think.
Okay.
There's a company called Horse Kicks.
Horse Kicks.
They're making custom designed high-end sneakers for
horses. Did Katie Greifeld give you this story?
No, I had to send it to her actually, because I told her, go get your horse a
Horse
sneakers.
Kicks. All right. Now, what's our market angle on this thing?
Well, it's just the price and everything. It's just a crazy story. So I had to use this. The company bills itself as the world's first online custom sneaker retailer exclusively for horses. They have hoof-size versions of classic sneakers like Air Jordans.
Come on.
I'm not joking. They're really incredibly funny looking. And they cost, guess how much per shoe?
$200 a shoe.
$1,200 per shoe.
Oh my goodness.
Per shoe.
Per shoe.
And a horse has at least two shoes, right?
Couldn't you just strap on a regular pair of Jordans onto them? It'd be cheaper.
I know you would think. Yeah, no, they're actually, so when you look at the pictures, they're tiny. They're really small, like little children's sneakers or something.
So $5,000 to?
Yeah.
Oh my goodness.
Yeah. To make your horse look very stylish.
All right. That's a pretty good one, Valdana. I'll give you that.
Thank you.
All right. Nela, that's pretty stiff competition, but I don't know. What do you got for us? You got something crazier than horse Air Jordans?
I don't know if I can top that. I mean, I'll stick with, there's so many crazy things going on, but you're looking for crazy thing data points. I am taken with this idea that California has replaced Germany as the fourth largest economy.
That is pretty interesting, yeah.
It is interesting, and I wonder what California does with that information, because I mean, that's a lot of responsibility for California, right? And right now, they've thrown a lot of political weight into the Supreme Court of protecting pregnant pigs. I am curious, being the fourth largest economy in the world, what other things do we think California will do with that kind of stature? So I guess I pose it as a question for the markets. What will California do next?
I was saying, I think that was our own Matt Winkler here at Bloomberg that wrote that story. He
I didn't see that. That's really good. I like that.
That's pretty good. I mean, it makes sense. It's, it's huge land-wise. It's huge population-wise.
Tech.
It's Silicon Valley and everything. It makes sense.
Almonds.
Almonds.
Yeah.
Almonds. Yeah. Almonds are a big deal.
Cauliflower. Do they grow a lot of cauliflower?
They might. Oranges.
All right. Two good crazy things. I like them both. I will give you mine. First, I have to ask, what's the most you've ever paid for a pair of earrings?
I've never bought earrings in my life.
You've never bought earrings in your life? Do you not have pierced ears? I've never noticed.
Just never.
You got the headphones. You always have the headphones on.
Yeah, you can't see.
But you never bought them? What do you make?
Not even once in my life.
You make your own?
No, I just don't wear them.
Oh, all right, right. But you do have pierced ears.
Yeah.
But how do they stay? I
don't know. I've just never worn them.
All right. More importantly to you, Nela, I think you have, if I remember correctly, you have sons, not daughters, right? So,
I have sons who I've taught to shop very well for their mama. So, yes.
What do you think the most they've ever spent on a pair of earrings for mom is? Over at that Short Hills Mall. I know you're a high roller at the Short Hills Mall.
A nice mall.
It is a nice mall, and my sons do enjoy that. It's not my shopping cart, but they do enjoy it. I would say, given since I know how much they make in allowance, I would say the most is for Christmas, maybe $50.
That's about
for a birthday.
That sounds reasonable to me. Yeah.
I have no idea.
My wife, I bought one pair of diamond earrings that were for the 20th anniversary, but otherwise 50 is about my limit. Two earrings. Okay, what if I were to tell you, do y'all know who Blue Ivy is?
Beyonce's child?
Beyonce's child.
Yeah.
Beyonce and Jay-Z have a child named Blue Ivy.
Everybody knows this. I thought for a second you were trying to stump us.
She's 10 years old. I don't know. I know I'm a hip old guy. I don't know about you though. I don't, I mean,
it's Beyonce.
All right. So Beyonce's daughter, Blue Ivy, and Jay-Z's daughter as well, she went earring shopping at, what was it? It was the Wearable Art Gala in Los Angeles, an auction, which gives it our market angle. And the story is courtesy of Vanity Fair. She bought a pair of diamond earrings from some designer who I think I should know who she is, but Lorraine Schwartz, famous earring designer. What do you think Blue Ivy paid for a pair of diamond earrings at the Wearable Art Gala in Los Angeles? Mind you, she's 10 years old.
Did she pay or did Beyonce pay?
She was the bidder. She had the paddle and she hit the bid. I don't know. I imagine Blue Ivy's got some revenue coming in.
Probably.
Speaking engagements. And
right.
I think she, time for the price is precise. What do you think precise. Blue Ivy spends on a pair of diamond earrings at auction?
Am I going first?
You always go first. Yes.
Yes. Okay. It has to be some absurd amount. But I thought 50 was...
$50 was an absurd amount?
Yeah. Okay. But obviously Blue Ivy won't spend that little. Okay. Let's go with $75,000.
$75,000. Nela, what do you think? You taking the over? Yeah, I'll let you can do the over or the under on 75,000.
But if you go over and it's under, then you lose, right?
Yeah.
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 I know whatever the result, my sons are going to ask for a higher allowance. Since this is a newsy thing, I'm going to say over, but I can't imagine how much over it would be from 75. I'll go up to 100.
All right. I think you win with the over. $80,000 smackers on a pair of diamond earrings.
Wow. I was close.
For a 10-year.
Yes, you were closer.
You're pretty close. You're pretty close.
So you win. I think you win because you were closer. That was.
Wait, you can't go over. Yeah, I win.
All right.
Yeah.
Sorry,
Nela.
You
two sorted out. You're all winners in my
That's okay. I was going to say 10, to be honest. And then you broke out with the 75,000. I was like, okay. I'll have to go over. But
80 grand
for a 10-year-old.
For a 10-year-old diamond earrings.
Well, it'll only go up from here, I'm sure.
Yeah. They're probably worth more now that she owns them.
What goes up?
Right.
I just cannot imagine a 10-year-old. Every sort of earring or piece of jewelry my kids owned at that age is
handmade.
It's covered in melted gummy bears and
made in arts and crafts class.
Right, and just completely lost. So we'll see. We'll have to keep track of I'm gonna go to the playground and just follow her around if she's wearing those $80,000 earrings
in case she drops them.
Well, congratulations to Blue Ivy on
yes.
Her $80,000 diamond earrings.
And she is welcome to do all of our Christmas shopping.
That's right. I know my girls have like 4 earring holes in their ears. They keep adding new ones. So I don't know if you need an $80,000 pair for every.
You have to raise their allowance too.
Yeah.
Nela's right.
This is not good news for me, is the bottom line here.
No.
The father of 3 daughters. But Nela Richardson, who is a Terp, by the way, very happy to say. I've got a daughter, econ major at the University of Maryland, and I'm proud to share the Terp pride with Nela. So
it's an excellent economic tradition that she has just joined. So congratulations.
I agree. Thank you.
What do we say? Go Terps?
Yeah, go. Yeah? Let's go Terps. Yeah,
let's go Terps.
6-2, bowl eligible in football. So
that's a good record.
Yep. All right. Nela, I think that's all our time. Thank you so much. It's always a real pleasure to catch up with you, and I hope we can do it again someday.
I hope so, too. Thanks for having me.
Thank you, Nela.
What Goes Up will be back next week. Until then, you can find us on the Bloomberg terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show on Apple Podcasts so more listeners can find us. And you can find us on Twitter. Follow me at Reganonymous. Vildana Heinrich is at Vildana Heinrich. You can also follow Bloomberg Podcasts at Podcasts. What Goes Up is produced by Stacey Wong. Thanks for listening. See you next time.